December 2025. While most of the world was distracted by the holiday rush, something quiet and tectonic happened in the heart of the global financial system. Gold, the asset central banks have used for centuries to protect against chaos, hit an all-time high of $4,400 an ounce. It didn't just double in price, it sent a signal. At the same time, in a secure facility halfway across the globe, the first digital transactions were being processed through a new instrument called the unit. This isn't a conspiracy theory, and it's not just another cryptocurrency. It is a gold-anchored system designed for one specific purpose, to operate entirely without the US dollar. Today, we are going to look past the headlines and examine the three mechanisms that are currently dismantling the dollar's 80-year monopoly. You'll discover why central banks are hoarding physical gold at levels not seen since the 1970s, and how a mathematical trap called the Triffin paradox has made this transition mathematically inevitable. By the end of this video, you'll understand exactly how this generational wealth transfer is unfolding, and more importantly, how you can position your own portfolio to survive a multipolar financial world. To understand where we are going, we have to travel back to 1944. Imagine a grand hotel in New Hampshire, Bretton Woods. The world was in ruins, and the British pound, which had reigned supreme for a century, was bankrupt. The British representative, the legendary economist John Maynard Keynes, arrived with a plan to save his currency, but he had no leverage. The Americans held two-thirds of the world's gold and owned the factories that the world needed to rebuild. The transition from the pound to the dollar didn't happen overnight. It took 30 years of war, debt, and economic shifting. But in that hotel, the exorbitant privilege was born. For 80 years, that privilege allowed us to print money to pay for everything from global military bases to the very technology you're using to watch this. But the same pattern that broke the pound in 1944 is now visible in the dollar today. The ghost of Bretton Woods is returning, and this time, the rules of the game have changed forever. To understand why gold hitting $4,400 is sending shockwaves through the upper echelons of finance, we have to look past the ticker price and into the psychology of old money. For decades, the global elite and central banks have treated gold not as a speculative investment, but as the ultimate insurance policy. In December 2025, that policy is being cashed in. While the average consumer is struggling with a dollar that buys 20% less at the grocery store than it did just a few years ago, gold has more than doubled in value since 2023. This isn't just a price hike, it is a loud, clear signal that the foundation of our fiat system is shifting. A clear example of this can be seen in the U.S. market today. In 1971, before President Nixon officially ended the gold standard, $1,000 could buy you nearly 28 ounces of gold. Today, that same $1,000 won't even buy you a quarter of an ounce. The old money families, those who have preserved wealth through world wars and depressions, know that gold doesn't actually go up. Rather, it is the currency used to measure it that goes down. When gold pivots to $4,400, it's a warning that the dollar's exorbitant privilege is beginning to evaporate. The data analysis backboards this fear. We are currently witnessing the third consecutive year where central banks have purchased over 1,000 tons of gold, the highest level of sustained buying since the collapse of the Bretton Woods system in 1971. These institutions aren't chasing hype. They are moving into an asset with zero counterparty risk, meaning it doesn't rely on a government's promise to pay its debts. The most valuable lesson here is simple. Gold isn't about getting rich, it's about staying rich. A common mistake many young investors make is viewing gold as a pet rock that pays no interest. But in an era of $36 trillion in national debt, the interest on a dollar is often offset by its loss in purchasing power. The old money understands that when the system transitions, you want to be holding the asset that everyone else is trying to get into. But why is the world suddenly so desperate for a gold-backed alternative? The answer lies in a new digital shadow falling over the dollar's dominance. If gold is the ancient shield of the old money, then the unit is the high-tech sword being forged by the New World Order. To understand this, we have to look at what happened in December 2025. While most of us were looking at stock tickers, the BRICS Plus nations, a bloc now representing nearly half the world's population, quietly launched a pilot for a gold-anchored digital settlement instrument known as the unit. Think of the unit not as a regular coin you'd carry in your pocket, but as a specialized digital ledger for countries to settle massive trade bills without ever touching a U.S. bank. Its DNA is a calculated blend of the past and the future. It is backed by a reserve basket composed of 40% physical gold and 60% in local BRICS currencies like the yuan and the ruble. This 40% gold anchor is the genius of the system. It provides a floor of real-world value that pure paper currencies lack, making it immune to the weaponization of the dollar through Western sanctions. A powerful real-world example of this shift is the fading of the petrodollar. For 50 years, the world had to buy dollars because Saudi Arabia only sold oil in dollars. But in a historic realignment, Saudi Arabia recently ended that exclusive deal, joining BRICS and opening the door to petroleum sales. Now, when China buys millions of barrels of oil, it can pay directly in yuan, which the Saudis can then convert into gold or units, bypassing the U.S. financial system entirely. The data analysis is staggering. In just the last 2 years, over $400 billion in annual trade has shifted away from the dollar into these local currency and unit-style arrangements. A common mistake for many in the West is to assume this is just a crypto fad or a China project. In reality, it is a coordinated blockchain-based infrastructure supported by Egypt, Iran, the UAE, and India, all seeking a neutral way to trade. The valuable lesson for us today is that the dollar's monopoly isn't ending because it's being defeated in a war, but because a more efficient, gold-backed alternative has finally arrived for the rest of the world. But this transition isn't just about new technology. It's a repeat of a pattern we've seen before. To see our future, we have to look back at the moment the British pound lost its crown. To understand the trajectory of the US dollar today, we have to look back at the hero's journey of the currency that came before it, the British pound. In the early 20th century, the pound was the undisputed king, accounting for roughly 65% of global reserves. If you wanted to do business anywhere from London to Singapore, you needed pounds. But history shows that reserve status is not a permanent right. It is a 30 to 40-year transition driven by debt and overextension. The Suez Moment refers to a specific turning point in 1956 that served as the final nail in the coffin for British financial dominance. While Britain had already been weakened by the massive debts of World War I and World War II, increasing its debt 11-fold in just 5 years, it was a geopolitical crisis that triggered the collapse. When Britain attempted to exert military force in the Suez Canal, the U.S. didn't use bullets to stop them, they used the pound. The U.S. threatened to sell off its massive holdings of British sterling, which would have decimated the UK economy. Britain was forced to retreat, and the world realized that London was no longer the center of the financial universe. This historical comparison is vital for us today because we are seeing a reverse Suez pattern. The U.S. has been militarily overextended for decades, spending over $8 trillion on conflicts since 2001 while maintaining 750 bases worldwide. Much like Britain in 1914, the U.S. has transitioned from a creditor nation to the world's largest debtor, with a debt-to-GDP ratio exceeding 125%. The lesson here is that reserve currencies transition over decades, not overnight. A common mistake is waiting for a total collapse to happen in a single day. In reality, the pound and dollar coexisted for nearly 30 years as the balance of power shifted. Today, the rise of China as the world's largest manufacturer and its unprecedented accumulation of gold suggests we are in the acceleration phase of that same historical cycle. As this exorbitant privilege begins to expire, the impact will move from the history books directly into the bank accounts of every American. For the past 80 years, Americans have lived under a specialized economic umbrella known as the exorbitant privilege. While it sounds like a term from a history textbook, it's actually the reason your life in the U.S. has been more affordable than it should be. Because the world needed dollars to buy everything from oil to iPhones, the U.S. could print money to pay for imports and borrow trillions at artificially low interest rates, essentially exporting our inflation to the rest of the globe. But for Gen Y and Gen Z, that umbrella is beginning to leak. As the unit and other gold-backed systems provide a viable exit for global trade, the demand for the US dollar is cooling. When the world stops needing as many dollars, those trillions of printed notes come home, driving up prices on everything we import. Real-world impact: the lifestyle deflation. Think about your daily life. A dominant dollar has traditionally acted as a massive subsidy on your lifestyle. It keeps the price of a German car, a Japanese gaming console, or a Chinese-made smartphone lower because our currency's buying power is artificially inflated. If the dollar loses its majority reserve status, we face a phenomenon called lifestyle deflation, where your paycheck might stay the same, but your ability to buy global goods drops dramatically. A $1,000 laptop could easily become a $1,400 laptop simply because our privilege has expired. The housing and debt trap. Perhaps the most painful hit for young professionals is the cost of borrowing, because foreign countries like China and Japan are buying fewer U.S. treasuries. The U.S. government has to offer higher interest rates to attract new buyers. This trickles down to you. It means higher mortgage rates, more expensive car loans, and a heavier burden on student debt. For a generation already struggling with housing affordability, the end of this privilege could mean an 8% mortgage becomes the new normal rather than a temporary spike. The valuable lesson here is that our standard of living hasn't just been built on hard work, it's been built on currency dominance. Understanding this helps you see that the rising cost of living isn't just a bad economy, it's a structural shift in the global hierarchy. However, the US isn't just sitting idle. As the global tide turns, the Federal Reserve is finding itself trapped in a high-stakes game of financial checkmate. To understand the current state of the US economy, we have to look at a scenario that financial historians call fiscal dominance, or more simply, the debt trap. As of late 2025, the U.S. national debt has spiraled to a staggering $36.2 trillion. For decades, this debt was manageable because interest rates were low and the world was hungry for U.S. treasuries. But as the de-dollarization trend accelerates and the unit offers a new exit, the Federal Reserve has found itself in a position of checkmate. The concept is straightforward but devastating. The Fed is now trapped between two impossible choices. If they raise interest rates to fight the inflation caused by a weakening dollar, the interest payments on that $36 trillion debt become unsustainable. In fact, interest payments are already consuming over $1.1 trillion annually, more than the entire defense budget. If rates spike further to, say, 8%, those payments could double, effectively bankrupting the federal budget. However, if the Fed lowers rates to make the debt easier to pay, they risk printing even more money to buy the bonds that foreigners no longer want, which sends inflation into the stratosphere. The quiet crisis in the Treasury market. A critical data point for any investor is who is actually buying our debt. Historically, China and Japan were our biggest customers. But by late 2025, China has slashed its treasury holdings by over $530 billion from its peak, choosing to store wealth in physical gold instead. With the big buyers leaving the room, the Fed has been forced to become the buyer of last resort. This is a historical red flag. It's exactly what happened in the late 1960s, just before the Bretton Woods system collapsed and gold prices exploded 23-fold. The valuable lesson for the 25 to 45 demographic is that the Fed can no longer save the economy without devaluing the currency. A common mistake is believing that a digital dollar or a new policy will fix the math. But math doesn't have a political bias. When a nation's debt grows faster than its economy, a wealth transfer becomes inevitable. This checkmate position means the old ways of saving are no longer safe. The question isn't whether the system will change, but who will end up with the bill, and who will end up with the wealth. In the world of macroeconomics, wealth is rarely ever truly destroyed. It is simply transferred from one pocket to another. As the dollar's exorbitant privilege begins to fade, we are entering the early stages of a $15 to $20 trillion shift, the largest movement of capital in modern history. To understand this, imagine a giant seesaw. On one side, you have the traditional dollar-based assets that have defined American prosperity for 80 years. On the other, you have the emerging hard assets and gold-backed systems like the unit. The winners, those who hold the anchor. The biggest winners in this transition are the gold holders. Since early 2023, gold has already more than doubled, and for those who recognize the pattern early, the returns have been generational. By 2025, with gold at $4,400, these investors aren't just beating the market, they are protecting their purchasing power while others lose it. Alongside them are the commodity exporters and countries within the BRICS bloc. As trade shifts toward the unit and local currencies, nations like Saudi Arabia and the UAE gain massive leverage, allowing them to capture the seigniorage or profit from currency creation that the US used to enjoy. The losers, the paper savers. On the losing side of the seesaw are the U.S. bondholders and traditional savers. If you are holding long-term 30-year Treasury bonds, you are essentially betting that the dollar will maintain its value for 3 decades, a bet that history suggests is becoming increasingly risky. As the dollar weakens, the real value of these bonds evaporates. Similarly, the American consumer faces a hidden tax. When the dollar loses just 30% of its global value, every imported television, smartphone, and gallon of gas becomes 30% more expensive in your local currency. The valuable lesson. The lesson for our 25 to 45-year-old audience is that neutrality is an asset. In a currency war, the person holding the asset that everyone accepts, like physical gold, is the person who retains their seat at the table. A common mistake is thinking you can wait it out in cash. But in a wealth transfer of this scale, standing still is the same as moving backward. Understanding who wins and who loses is the first step toward protection, but knowing the why isn't enough. You need a concrete 10-year strategy to navigate the final phase of this transition. Navigating the next decade isn't about predicting a collapse, it's about preparing for diversification. As the unit and other gold-anchored systems become operational, the 10-year action plan for any U.S. investor aged 25 to 45 must shift from a dollar-only mindset to a global resilience strategy. Assets. The most critical step is acknowledging the strategy already being deployed by the world's most sophisticated financial institutions, central banks. Since 2022, central banks have purchased over 1,000 tons of gold annually, a 122% increase over previous averages. For the individual investor, this means moving beyond the traditional 60-40 portfolio. Financial advisors are increasingly suggesting a 15-25% allocation to physical gold or gold-backed instruments to act as a hedge against currency debasement and geopolitical sanctions proofing. A valuable lesson from the world of international finance is the concept of life liabilities. If you plan to live in the U.S., your liabilities, your mortgage, food, and taxes are in dollars. However, if those dollars lose purchasing power, your domestic cost of living effectively rises. A practical 10-year plan involves diversifying your life assets by holding investments that generate income in multiple currencies. This could include international quality factor ETFs or multinational companies that earn 50% or more of their revenue in euros, yen, or yuan. When the dollar weakens, these foreign earnings translate into more dollars in your brokerage account, providing a natural cushion against lifestyle deflation. The historical lesson of currency transitions is that long-term fixed-income assets, like 30-year Treasury bonds, are the most vulnerable. As foreign demand for U.S. debt falls, with China alone dumping $53.3 billion in treasuries in a single quarter, interest rates must rise to attract new buyers. A smarter move for the next decade is keeping bond durations short, 2 to 5 years, to avoid being locked into low yields while inflation erodes the principal. The patterns of history are clear. The exorbitant privilege of the dollar is evolving into a multipolar world. By positioning yourself alongside the old money and central banks in hard assets, you aren't just surviving the transition, you are capturing the largest wealth transfer of our time.